studying your last two. I swim med tea when they turned in. The staring down to mute. And can learn the pole that sunk he died.
Now it's time to move from planning theory to actual calculations. The first step in determining NERDTOH's optimal dividend strategy is to deal with the most restrictive account on the dashboard, NERDTOH. As shown at the top of the slide, Barnes Dentistry has three important tax accounts. However, for this first step, we temporarily ignore GRIP and ERDTOH and focus only on NERDTOH. NERDTOH's corporation has a NERDTOH balance of $12,000. Remember what NERDTOH represents. It is refundable tax that has already been paid to the Canada Revenue Agency. The corporation can recover this tax, but only if it pays enough non-eligible dividends. This is why NERDTOH always becomes the starting point of the dividend planning process. The next question is, how much non-eligible dividend must be paid to unlock the entire $12,000 refund? To answer that question, we use the dividend refund formula shown in the center of the slide. We take the NERDTOH balance of $12,000 and divide it by the dividend refund rate of 38.33%. When we perform the calculation, the result is approximately $31,305. This number is extremely important. It represents the minimum non-eligible dividend required to recover the entire NERDTOH balance. Notice the word minimum. The corporation could pay more non-eligible dividends if it wanted to, but from a tax planning perspective, paying more than necessary may not be ideal because non-eligible dividends generally produce a higher personal tax burden than eligible dividends. That's why professional advisors usually start by determining the smallest non-eligible dividend needed to recover the refundable tax. On the right side of the slide, we can see the result. The NERDTOH vault unlocks. The corporation becomes entitled to a $12,000 dividend refund, and the CRA returns that refundable tax back to Barnes Dentistry. Money that was previously trapped inside the NERDTOH account is now available to the corporation once again. This is a major planning win. By paying $31,305 of non-eligible dividends, NERDTOH's corporation recovers $12,000 of refundable tax. The key insight banner at the bottom summarizes the entire calculation. To recover the $12,000 NERDTOH balance, Barnes Dentistry must pay at least $31,305 of non-eligible dividends. And that brings us to the most important lesson of this slide. Before thinking about GRIP, ERDTOH, or eligible dividends, the first priority is recovering NERDTOH. Because NERDTOH is the most restrictive account, it must be addressed first. Once the required non-eligible dividend has been calculated and the refund is secured, we can move on to the next stage of the strategy. In the next slide, we'll determine how to use NERDTOH's remaining dividend requirement, GRIP balance, and ERDTOH account to maximize tax efficiency and minimize personal tax. In the previous slide, we completed the first priority of the dividend planning process. We determined that Barnes Dentistry must pay $31,305 of non-eligible dividends to recover the entire $12,000 NERDTOH balance. Now it's time for step 2. We need to decide how to satisfy the rest of NERDTOH's dividend requirement in the most tax-efficient way possible. Let's start with the numbers. NERDTOH wants a total of $120,000 of dividend income. We've already allocated $31,305 of non-eligible dividends to recover NERDTOH. So we subtract that amount from the total dividend target. $120,000 minus $31,305 leaves a remaining dividend requirement of $88,695. This is the amount we still need to distribute. Now let's look at the tax attributes available to help us. On the right side of the slide, we can see that Natasha's corporation has a GRIP balance of $75,000. This means the corporation can pay up to $75,000 of eligible dividends. Remember why GRIP is valuable. Eligible dividends generally result in lower personal tax compared with non-eligible dividends. The corporation also has an ERDTOH balance of $8,000. And unlike NERDTOH, ERDTOH is flexible. The refund can be recovered through other eligible dividends or non-eligible dividends. This flexibility gives us an important planning opportunity. The planning flow in the center of the slide shows the advisor's logic. First, identify the remaining dividend requirement. Second, use the available GRIP balance. Third, pay eligible dividends. Fourth, recover the ERDTOH refund. And finally, achieve a lower personal tax result. Now compare the two possible paths shown at the bottom of the slide. The eligible dividend path provides three advantages. It uses the available GRIP balance. It allows the corporation to recover ERDTOH, and it generally produces lower personal tax for Natasha. The non-eligible dividend path does not provide those same benefits. After NERDTOH has already been recovered, paying additional non-eligible dividends often results in higher personal tax without providing significant additional planning advantages. That's why the tax advisor's recommendation is highlighted at the bottom of the slide. Use available GRIP first, before paying additional non-eligible dividends. This is a critical planning principle. Once the minimum non-eligible dividend has been paid to recover NERDTOH, the strategy usually shifts toward eligible dividends whenever sufficient GRIP is available. This allows the corporation to take advantage of both GRIP and ERDTOH while reducing the shareholder's personal tax burden. The key takeaway from this slide is simple. After recovering NERDTOH, use eligible dividends whenever possible. GRIP supports eligible dividends. ERDTOH can still be recovered, and the overall tax result is usually more favorable. In the next slide, we'll combine all of these pieces together and determine Natasha's final optimal dividend mix. The strategy that maximizes refunds, uses GRIP efficiently, and minimizes overall tax. We've now completed all the analysis. We've reviewed Natasha's GRIP balance. We've examined both ERDTOH and NERDTOH, and we've determined the minimum dividend required to recover refundable taxes. Now it's time to bring everything together and identify the optimal dividend strategy. Let's start with the most important constraint. Natasha's corporation has a NERDTOH balance of $12,000. As we learned earlier, NERDTOH is restrictive. To recover the full $12,000 refund, the corporation must pay approximately $31,305 of non-eligible dividends. This becomes the first component of the strategy. Notice that we are not paying more non-eligible dividends than necessary. We are paying only the minimum amount required to unlock the entire NERDTOH refund. That is a critical tax planning principle. Once the NERDTOH refund has been secured, the focus shifts to GRIP. Natasha's corporation has a GRIP balance of $75,000. This allows the corporation to pay up to $75,000 of eligible dividends. And because eligible dividends generally result in lower personal tax than non-eligible dividends, we want to take full advantage of this eligible dividend capacity. So the second component of the strategy is to pay $75,000 of eligible dividends. This uses the entire GRIP balance efficiently. At the same time, those eligible dividends help recover the corporation's ERDTOH balance of $8,000. This is possible because ERDTOH is flexible and can be recovered through eligible dividends. Now look at the pie chart in the center of the slide. The optimal dividend mix consists of two parts. Approximately $31,305 of non-eligible dividends and $75,000 of eligible dividends. The non-eligible portion exists because NERDTOH requires it. The eligible portion exists because GRIP supports it, and because it generally produces a better personal tax outcome. This combination achieves multiple objectives simultaneously. The scorecard on the right summarizes the results. First, the corporation recovers the entire $12,000 NERDTOH refund. Second, it recovers the $8,000 ERDTOH refund. Third, it uses the full $75,000 GRIP balance. And fourth, it reduces NERDTOH's overall personal tax burden by maximizing the use of eligible dividends. This is exactly what professional tax advisors aim to accomplish. Not just recovering refunds, not just paying dividends, but coordinating all available tax attributes to achieve the best combined corporate and personal tax outcome. The planning flow at the bottom illustrates the complete process. Start with NERDTOH. Determine the minimum non-eligible dividend required. Recover the refund. Use the available GRIP balance. Pay eligible dividends. Recover ERDTOH. And arrive at the best overall tax result. The trophy shown on the right side of the slide symbolizes the final outcome. The strategy works because it balances competing objectives rather than focusing on only one. The key takeaway from this slide is the professional rule of thumb. Pay the minimum non-eligible dividends required to recover NERDTOH. Then maximize eligible dividends using available GRIP. This approach recovers refundable taxes, minimizes personal tax, uses corporate tax attributes efficiently, and produces the most favorable overall result. And that's why tax advisors often view this as the optimal dividend planning strategy when both NERDTOH and ERDTOH balances exist within a corporation.